Hey, there we are. Hello and good evening, everybody. You are here with the crew and Mr. Simon. Simon says crypto. Hey,
Mr.
brother.
Allen, how are you?
Good, man. Dandy, dandy. Really, I'm excited about getting further into this IBC and getting to know more about what we know about it and what we can share with people about what we've learned about it. What do you got for us, Simon? What are you up to tonight?
Actually, I would like to share a current story
Nice.
in regards to IBC. JV,
Yes.
and
He'll be on the
JV,
show.
JV. Yeah, actually, let's talk about that after the show. That part, yeah, I'd like. I talked schedule with him, but anyways. During my journey, he's like, "Hey, man, you should be writing your stuff down so you can share it with people, as you go through it." And I was like, you know what? I'll probably just, do a vlog on it or something of that nature. And so here I am in real time. I would like to share my recent experience with the infinite banking concept, taking a policy loan, becoming my own banker in this transaction, and what I got with it. So I recently acquired a Toyota Scion XB, the square looking box on wheels. And the reason for this is I've been trying to find ways to free up money, right? If you can't earn more money, then maybe you need to free up some money. That's kind of really the only way it goes. Either you make money with money, you bring in more money, or you free up money. So, I'm all about my budget whenever I can be, and just kind of readjusting, making adjustments. I know people out there that do a lot of streaming as far as their entertainment, Netflix, my gosh, I'm brain farting. Disney, Prime, like there's a whole slew of apps, right? So every now and again, I'll go through those, cancel some subscriptions, and switch over to different providers, just using that same money and getting my entertainment value that way. So back to freeing up money. Well, I was doing some math with my monthly budget, and I saw how much my fuel cost is for me to go to work, come home, plus all the other extra running around that I typically do in a week. And each week that was costing me $300 in gas just for my ride. So that's every 4 weeks. That's $1,200. I know, it's $1,200. So
big money.
Yeah, it's a lot of money. So I started trying to figure out, okay, I need to figure out which cars can go the same distance mine already goes, and just with a smaller gas tank. So that's how I kind of got on this journey. And so I came across two cars. One was the Toyota Scion, and the other one was a Honda Civic. And both of them in their older models have a 12-gallon tank, but they both go about 340 miles per tank. And that's what my truck gets, is about the same, 340 miles on a tank. So in retrospect, I kind of saw some other, I don't want to call them illusions, but like we hear numbers and we're like, oh, I'm doing so good. It's like, yeah, but are you really? Are you really? And so this journey kind of made me do a hard look at, it doesn't how many what miles per gallon you get, what the retail sticker says. It's like, how big is the tank? How much does it cost to fill it up? And how far can I go? That's it. And that will give you your simple math. So I figured that out, that with the Scion, I would save $600 a month if I went that route, and nothing would change in my life, right? I wouldn't have to make any other cut back on how I just deal with life, work, or, can't go to the grocery store these days, all those other like kind of unnecessary adjustments. Some are necessary, but I kind of like to just define, how can I keep doing the same thing and spend less money doing it? I love finding those things.
That's, what, 600 a month times 10, right? $7,200 a year, right? Bingo.
Yeah, bingo. So now that I had my solution, right? You know, of like, okay, I need to find this. I found the vehicle, and now the one thing that we all run into, right? How am I going to pay for this? And I had already been.
Damn it! You got to pay for it.
I know. I mean, come on, universe! You provide everything. Why can't you just give it to me for free? Universe, because you won't learn anything. So I set a budget of like $3,000, you know, because I was already in process with the infinite banking concept, getting my policy, getting my bank started, and I had started my bank. I had cash going to PUA, so I was looking already kind of in the wasn't 100% in the market to take my first loan.
What's a PUA again?
PUA is an acronym for paid up additions. Means additional death benefit. And when you do this, there is arguably a direct correlation within what you're able to borrow against your cash value when you buy extra pay up when you buy PUA. But we can dive down that rabbit hole another way. And thank you for asking that. That's a good question.
Yeah. I just try to get it from the beginning.
Yeah, no, I know. You and I get together and we talk shop, and we can leave people behind. So I had some money in PUA and I had some cash on the side. And the reason why I left the cash on the side and not putting it in my policy right away was I didn't know what the turnaround time was going to be for the insurance company that I'm using and how long it would take for me to get a loan. If I bought more PUA, if that would like delay the loan because more money's coming in, they don't have all the numbers, like all these things. And a lot of this discussion was with JV and his personal experience and what he knows thus far in the insurance industry and with IBC. So I decided to belay that cash and hold it on the side. I was able to get my loan. So I had a total of $4,000 to work with. I didn't want to spend the whole $4,000. I really wanted to try to spend $3,000. I felt that was good enough. And the reason why I chose $3,000 was because back to the $600. I really didn't want a car payment for myself that was going to last for a year. And that's just me being a good debtor. I want this on the debtor side. I'm like, I want this thing gone, right? That's what we are trained to do. Pay off your debts as fast as possible, right? But on the banker side, yeah, I know. But on the other side, I'm like, well,
yeah.
I mean, okay, I hear what you're doing there. You know, I'm having this internal conversation with myself. And so I said, okay, I know within 6 months I can pay this loan off with the agreed upon interest. By the way, I'm charging myself 20%. Simple interest, but I'm still charging myself 20%. And I even may charge myself an early payoff fee as well. You know, doesn't matter.
Wait, let's back up just a little bit.
Yeah.
Why don't we real quickly explain the difference between accrued interest and simple interest?
Okay. I can share my personal experience because I didn't go to school for that. But simple interest is thus: if you have $1,000 and your simple interest rate is 10%, then the outstanding balance is $1,100 for the term of the loan. So your term is how long the loan goes for, rather, right? If you're doing a 5-year loan, a 3-year loan, a 1-year loan, a 1-month loan, you know, that's the term, the length of time within that contract.
Right.
Accruing interest is it's kind of like the infinite banking concept part where we're compounding our interest within our policy, only we're on the other side of that. That interest is compounding sometimes on a daily basis, and then we pay a little bit. We make a payment to our loan. In the normal world, I'll bring up the house.
I'm with
my
you.
house payment. My house payment is $2,500. $1,800 goes to interest.
Yeah.
There's a little bit for insurance, a little bit for escrow, and then this tiny little sliver of $123 goes to the balance. Okay.
Yeah.
That's the difference.
That's a big difference. Yeah.
That's a huge difference.
And,
I know I interjected on the house there.
Yeah.
And
I was just trying to, because you threw another little lingo term in there, and I'm just trying to catch everybody up.
And I know I'm talking too fast.
No,
So, and I actually did, Alan, I actually did sit down on the computer and I went to find a loan calculator. So maybe I could set my terms from the banker's perspective. Maybe I don't want to do simple interest. Maybe I want to charge, a standard rate of interest in a standard rate of terms. But I came to the decision, no, we're going to charge me a lot of interest right out the gate. I just want to see how this process works. And I want to experience the benefits I want to experience the benefits. What is this all going to do for me? Was it worth it? Did I do something wrong? Kind of science that really break it down for myself.
Guinea pig.
Oh, yeah, totally guinea pig. And for my budget and what I have going on in my life, $3,000 is enough to go. That's kind of uncomfortable. That's $3,000. XRP just dropped to 40 cents a few days ago, and boy, I'd really like to get some more of that.
I need more XRP.
But I made my decision. So I got the ride. Yes, it was. I did a lot of thinking on this. A lot of thinking. A lot of non-emotional.
Yeah.
$600 a month. I'm charging myself 20% interest on $3,000.
Now,
so
why
that's
20%? Huh? I mean, that seems a little steep to me. Are you just guinea pigging it and just see what happens? Because you can afford it right now.
I did. Okay. No, it's kind of a combination. Okay, wearing my banker's hat right now.
Let me ask you one quick question.
Sure, go ahead.
Okay, the quick question I have is, what are they charging you to take the money out of your account?
Okay, now I'm gonna get into that in just a second. So let's go back to your original question, Simon. Why 20%? Well, first in my banker, and this is just my process. This was the first thing I thought about was my bank needs to make money. My bank makes money on loans by interest. Okay, so but I'm doing simple interest. So from the banker's perspective, it's like, no, we'd kind of rather have the standard rate of return that JP Morgan across the street does. But I'm guinea pigging this. So I figured 20 was a good number. 20% was a good number to go with. I said, okay, maybe I'll raise that. Maybe I'll lower that. Just depends. Now let's get to your question, your other question. How much did the insurance company charge my bank, my policy?
That's right.
For the loan. They charged me 5.86% interest. And that is simple interest, but it renews every year. So whatever's outstanding, it's they will actually let me see if I got it right here. They will not only reevaluate they will actually reevaluate the interest rate in that year. So this interest rate that I have at 5.65% is good for 1 year. Next year, they'll reassess and renew and see if that's all good from their perspective. So they could charge me a maximum of 8% this time next year. Okay. Right. So they're charging me, but back to your question, they're charging me 5.65% interest. So on my $3,000, we'll just leave it at $3,000 because I'm not going to confuse everybody in the math. On my $3,000, but I am my bank is charging me, the borrower, the end of the line borrower, 20%. So that means my company will net the 14.45%.
Correct.
interest. That will go to my bank, and then the insurance company will get their principal back and their interest rate as well. So everybody's a happy camper on that front. Let me tell you the really exciting news that I figured out today. Rather, I figured it out on paper, but it felt good to do it today. Let me tell you.
All righty.
So for the past 3 days.
Yeah.
Okay.
Yeah.
For the past 3 days, I've been driving my little happy butt off, man. In traffic, I'm throwing out emissions into the universe, just because I wanted to see how good gas mileage I actually get. I know. Elon's gonna come over to my house and spank me and say, "Get an electric."
Yeah, that's what I'm gonna do.
Right. I'm like, well, my bank's not that big yet, Elon. Just wait, it's on the menu.
Right.
So I just wanted to see how much good gas mileage I was getting, and so today I filled up with 9 gallons. Now coming from a truck that's 25 gallons and going the same distance, and it would cost me about anywhere from $100 to $125 to fill up. And today I paid $33.86.
Yeah,
that is a huge gain, but that's something that Nelson actually talks about in the book. It's not what's seen, it's what's unseen. That arguably is an unseen gain, right? Because we don't get it instantly. I recognize it in that moment. I only had to pay $33 and change for gas today on my vehicle, right? That's a win.
Yeah.
So what happened right after that? I shut my door. I started driving. The creative mind turns on and goes, okay, so why don't I just take $33 off the top? It goes into the tank, but the rest of my standard fill up, if I did the truck, I'm gonna take that money and throw it over there. This is how I'm executing on that unrealized, that unforeseen gain. Now I'm making it seen. I'm going, nope, you go over here, because I was going to spend that money anyways. No matter which way I go, I was going to spend it anywhere. Right?
Yeah.
It was gonna go right into, whatever gas station I was at. They were gonna get all that money. Nope, not today. That's going to my bank. Now I've got a choice of how I want to apply that in my process. But what I'm doing there is probably one of the biggest things in this process that we got to recognize, and that's reclaiming our money, physically taking that, and not just going, I didn't have to pay this today. Well, there's another part of that. There's another part of that. Cool. So take that money and put it somewhere else.
Yeah, that's right. And it's not always how much money you make. It's sometimes how much you save, obviously. But it's also
penny saved, penny earned.
Right. And then what you're talking about doing next is you've paid the 20% extra, okay, to yourself, basically, paying yourself back in interest. And now you're talking about going, well, every time I fill up my gas tank, I'm gonna actually charge myself more because of what I saved from driving a V8 to a 4-cylinder. I'm gonna potentially put that in my account, and it's gonna grow, and you're gonna pay back the car loan twice as fast. Which is gonna enable you to get more money and pay back to your insurance so that you can go use that money to go do something else, which is going to make more money than what you already just made.
Exactly.
All the while, the principal has compounded and earned interest while you were doing this.
It's a great it's a great day to be a cheapskate.
It's a great day. It really is. I want to get into one that's a very difficult question here because he is a good brother and I don't want to pass by. Christy, hello, girl. So glad you're in here. She's bouncing on as Solar Sam. My buddy Sammy. I called you today, brother. I didn't get any answer. What's up with that? Anyway, I've been really busy. My phone is forget about it. Yeah. You can't leave my box is a little full.
Hey,
Might get a
can
lot
we
of
just can we just air out a little dirty laundry here, Alan?
Yeah,
I do
can we
have just a side question. Do you actually clean out your voicemails?
I, occasionally.
Okay, all right, that's cool. That's cool. I just wanted.
I know it sounds crazy, but if somebody calls me, I usually call them right back.
Yeah, that's kind of how I am.
I
The question.
I don't listen to damn. Don't even leave one.
I
When you
don't.
ring me, I'll call you back. It's kind of the way I play it. But anyway, that's the way I'm looking at it. Okay. I want to tackle this one because there's about 4 answers to Mr. Crypto Professor.
Always
Our
got
brother.
good questions.
Oh my God. Yeah, I know. He always. Okay. Does it benefit you to pay off your loan early? Well, we just gave you a scenario that actually would. Yes, of course. However, if the loan in which you've taken out is earning you money over the interest rate in which you borrowed it at, in Simon's case, 5 point whatever it was, if you were earning 6, 8, 10%, and by the way, 12% can be achieved these days pretty solidly out there in the market, believe it or not. So if you were in that case, obviously not. It wouldn't be. However, if you were trying to do something like pay off a credit card and your credit card's 29% and you're trying to pay that off early, I think that would be very beneficial. So it depends on what the debt is that you're trying to pay off on the loan that you've borrowed. I hope that makes sense. So the answer to that question, Professor, is sometimes. There's no definite answer to it. It depends on the loan you've drawn and the paper you've written and the deal you made. There's a lot of debt out there that you're, honestly, God, I've never, ever believed this until just recently, until understanding IBC better. I can make a great case for you to never, ever pay your home off. And I never would have said that in my whole lifetime before. And because you're simply not paying that much in interest rate on a home loan. Okay. You're just not. I know you're missing out a lot of principal. I get all that. But what I'm saying is there are better debts than a home loan to be borrowed. In other words, you can earn more money from other debt purchasing. So I hope that if you, like, so many people say, oh, well, I'm paying, like you, for instance, you mentioned I'm paying $2,500 a month. Okay. To buy my house. Okay. The first thing you're thinking of, I'd like to get out from underneath that debt. Depends on your income level, depends on what your debt is, and depends on what your payments are. Like in a situation with Elizabeth and I, our loan is minuscule on our home, and we are in a position to where that might be a good one to pay off last, believe it or not, because it doesn't cost us much.
So we have a moral obligation.
Right. The volume of money in your guys' situation, the volume of money that is applied to interest is far lesser than other ones.
That's correct.
Right. Yeah. Okay.
And so it really, the only way to look at this is to fully understand IBC. Okay. And I mean, really understand it. In other words, you have to reverse everything you know about interest rates and everything you know about banking. And you have to start thinking like a bank, not like a person that's dealt with a bank your whole life. Once you start thinking like that, then you can sit down with an IBC rep, okay? And you can sit down and tell them, here's my debt on this. This is what I owe here. This is what I owe a student loan. This is what I owe here. Boom, 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 boom. Here's my debt column. And you both with the IBC professional is going to sit down and they're going to say, okay, well, why do you want to get rid of this one first? And they're going to educate you as you go through each column and each category and say, well, Now let's think about this, because you're going to pay this one off quicker. Although it's cheaper, it has a higher interest rate. That might not be the better bill to pay if you can afford to get out from under the one that costs you $500 a month instead of the one that costs you $150 a month, because now you can get the extra $500 a month and put it back to work into your circuit, into your bank.
Exactly. It's about freeing up money.
That's right.
You know, yeah, freeing up money, like exactly what
I'm going to call capital. Principal.
You're freeing up your cash flow. If you're sending, let me make this statement here because it's all over the book, right out in the beginning too. We're trying to reclaim. First off, we're taking over the banking functions and reclaiming those and reclaiming the control of the banking function in our lives. A component of that is the interest. So instead of sending the amount of money, volume of money per loan that we have out there in the public, instead of sending that money across the street to, again, JP Morgan Chase and friends, we're pivoting that money, button hooking it, and coming back to our bank, the banking system that we control, and it's out of their hands. So, yes, it does depend. It depends. It really does. I picked one. I stuck to the principles. What thing in my life is costing me the most money aside from my house? Because I know that's, like, I can do the math there, unattainable right now. Like, no way. I need to free up all the other little things, and then take that pile of money and then later apply it to that.
That's correct.
Probably not. I'll probably get a whole bunch of businesses and other things, and those businesses will take care of the house. That's the bigger picture. But yes, it does depend. Right. Now let's come from the debtor's perspective, though. Okay, just the debtor. And I know or the borrower, the end borrower. I'm going to try to say the end borrower as opposed to the retail person that gets the loan. So from that perspective, is it beneficial for that person, any one of us, to pay off our debts early, just in the normal banking system that we currently participate in? Does it benefit us if we pay that off fast? Yes, it does. If I paid off my car, I'm just only speaking to debt. I'm not talking about the things you can do with money.
Okay. Depreciating assets, I would say yes. Appreciating assets, I would say maybe. Maybe.
I'm gonna say an asset is a thing that doesn't continuously cost you money. Therefore, it's an asset. Until then, it's a liability. That's my opinion. Because
we're talking
if it's caught, because it diminishes the return. But I don't want to go down that rabbit hole. We could talk all day on that too.
I know.
But just to maybe help the professor along in a question as well, of like, hey, would it benefit me to pay that off early? Well, of course, yes, it would benefit me to pay off my car loan early, because now in my simple world, I don't have to make that car payment anymore. But the buck doesn't stop there. Yeah. Now, what have I inevitably done? I have freed up cash flow that doesn't go into any banking system, including my own. Like, that's a good thing, because now that money, guess where it's going to go in my situation? It's going into my banking system like you wouldn't believe. It's just going to keep on going over there.
Right. No, that's true. But let me give you a for instance, just quick, and I don't want to confuse anybody. Okay.
Yeah, it's okay.
So you owe $100,000 on your home, right? And you've got a decent loan. You're paying 5% interest. Okay. But you've got these credit card bills over here. You got these other bills. You got whatever it may be, a car loan, all these other things that are at probably over 5%. Okay. 7, 8, 10%. Credit cards probably at 29, and you're sitting there with 10 grand with credit card debt, and you've been paying the minimum forever. In that situation, you're better off taking more debt. I shouldn't be saying better off. I don't want to be anybody's financial planner, but you're better off taking a HELOC and borrowing more against your home, a second, if you will, and pay off all of those other brutal debts, okay? And then using that money, putting half of the HELOC money into your IBC policy, then you have more capital to work with. Now you're paying all of those other credit cards off with more home debt. So paying off your home in that case is not a great idea. You want to borrow against it because it's truly, in the bank's eyes, and bank's eyes in particular, the best, most secure asset you own until they get smart enough to understand how important Bitcoin and crypto is. Until that day, they're going to look at home loans. So in that case, I know that's a one-off, but there's going to come a time, guys, where you're going to say to yourself, wow, I need more capital. Where am I going to find the capital? Because I want my bank to get bigger. How do I get my bank bigger? Well, your bank will stay tiny and really small if you pay off your home. See what I'm saying? You're not going to have the annual working capital to when all of a sudden you've got, because you want to have 10, 20 grand in there and float, because the opportunity is going to come along and somebody's going to say, hey, Alan, guess what? You can make 15% on your money right now. Are you ready to go? Do you got 15 grand? Do you got 20 grand? We need minimum 20 grand in.
Right.
Going, whoa, wait a minute. My mortgage is only 5%. Why wouldn't I get a HELOC, pull it over there, make 10 extra percent and pay myself back? Because like his follow-up question, he said that makes total sense. He was concerned with paying off sooner and to assume the ability to put back your next loan matters. What he was concerned about is, how do I pay back the insurance? Does the insurance care that I'm running late on the payments, or I'm going to borrow it longer? And the easy answer to that is what, Simon?
Nope.
So
let me
share
a little. I'll share a little technical. I'll share a little technical with you.
Let's go.
I got a little. They gave me a couple different options here. You can let's see. Let me give it a quick preview before I just out all my dirty laundry on Main Street. Make an election, please. Okay, here we go. So these are the.
Can I say something real quick to Oak? Oak, you've mentioned you've mentioned fixed rate loans 2 or 3 times. It sounds like you're in Canada because they fluctuate every 5 years, right? But maybe you're not. That loan that you get from your insurance company is a fixed rate.
Simple interest.
Simple interest, fixed rate. It will not increase over time. Okay, go ahead, Simon.
And the reason why it won't is because it's part of the contract. Arguably the only enforceable thing we have on this planet.
Yes. Okay.
So, via contract, here's what I can do. You can repay your policy loan by using a systematic payment method described below. To make an election, please complete the information and choose one of the following options and return it to Lafayette Life, etc., etc., etc. Okay. Option 1. Send me a bill for however much, a one-time bill, and I have to make a minimum $25 payment. Now I get to choose. Well, there's one-time bill. They also give me a semi-annual option, a quarterly option, or a monthly option. Okay, so what are we doing here, Alan? What do they give me the choices to do?
Be your own bank.
Set my own terms.
Set your own terms.
They're giving me the choice to set my own terms. What works for me in my world, not whatever they want that we're all used to.
What benefits, Simon?
Yeah, what benefits, Simon? That little car out front does. I'll tell you what. Put a smile on my face. Yeah. There's also, I can do a a direct deposit, or rather a withdrawal for this loan. By the way, I have to give them the authority to do that, even though they're already doing that for, in my situation, they're already doing that for my obligations for to fund the policy. They're already doing that, but they need second permission to take funds out to apply it to this loan. It's two separate things. I found that very interesting. I'm like, oh, I like this. This is clear cut, dry. I'm not just giving you my banking information and you can do whatever the heck you want, like, everything else.
Yeah.
Another one is, my third option is I elect to start a pre-authorization withdrawal and repay my policy loan once I'm completing returning the enclosed pre-authorization withdrawal. So that starts that immediately on my third option. So I got three options, and I'll tell you right now, right out the gate, you guys can bill me semi-annually. I want one bill now, one bill later. That's what works for me. I could take a monthly bill because I'm already in a monthly budget. It's whatever works for me. Now, my question that I have yet to get from the insurance company is that minimum payment of $25. Is that per bill? How does that work out? But those are just details. Anyways, I'm very excited about this because, again, I get the control. I get the choice of what works. I get to choose the amount, $25 minimum or more per year. At least one payment of $25, and I'm golden. So if I need to, something happens,
which is
Alan and I go on a trip to a different state and I don't come back for whatever reason. It's good. I'm sure.
Don't even get started with that.
I'm just kidding.
Yeah.
I'm totally kidding.
Yeah. Well, we
So,
know.
Hope that answered the question.
It did totally, and now I was it really set a light bulb off for me because I wasn't even aware that they gave options like that. That's kind of cool on one hand. On the other hand, it's like, oh, well, what if I wanted something different than that? You could probably negotiate that.
I can answer that for you.
Okay.
So this is setting the baseline terms. I can totally go in there and dump a loan payment in there. I could pay it off like that. There's no ifs, ands, or buts there's nothing that's stopping me from doing that. Okay. Bank to bank, or banking system to banking system, right? From policy owner to the insurance company, right? I can totally do that whenever I feel like it.
That's right. And getting back to my answer to the second question that Professor asked, the quicker you pay that back, the quicker. Let me boil this down real easy for everybody. Chucky, I love you got your book, brother. That's cool, man. Yeah, just read that thing and figure it out because we got a lot to learn together here. Let's just boil this down to real simple. The simplicity of it. See if I can make this simple. You put 10 grand into a policy. I'm just going to use 10 grand because it's an easy number. Okay. You're able to borrow against that 10 grand. The sooner you pay that money back to the 10 grand, the quicker you'll have more than 10 grand the next time you want to borrow. Because if you're wise, you're going to pay the interest you would have paid to a bank. So it's going to increase and become more than 10 grand because it's going to have interest, compounded interest with it. And it will have a dividend of some kind. 99% chance of that's going to get a dividend as well. Now let's talk about what the difference is. You go to B of A and you say, I want to open a checking account or whatever. And you put 10 grand in it. Okay. Mm-hmm. When you put the 10 grand in the checking account, you say, I want to buy a Scion for 6 grand or whatever. Okay. How much interest are they going to give you? 0. How much interest are they going to charge you? More than a life insurance policy. I can almost guarantee that. They're also going to say, well, wait a minute, Mr. Staple, you spent $6,000 of your 10 grand. You don't get any interest on that $6,000, Mr. Staple. I don't know where you were come from, but that doesn't happen in this world. The difference between using a life insurance as your bank and a bank for your banking is exactly that. You will always have the amount that you put in earning interest for yourself. Not all, yes, almost always. Okay, I'm going to say, right? The difference is, as soon as you use your money from a real bank, there are costs, there are problems, there are inquiries. They're going to wonder, why are you spending this money? What are you spending this money on? How come you took it out? I need you're going to be 1099. The government's going to know exactly what you did with every single one of those dollars. And you have a life insurance policy with 10 grand in it, and you spend it over on a purple Cadillac because you happen to like the thing. Nobody will know that you bought the purple Cadillac in the government, period. They don't dig into people's private accounts in life insurance accounts. This is what I'm learning about life insurance. It's like, well, that's just kind of life insurance. Those are just policies over there. We don't need to know that they spent $600 on. You and I, when we pull $600 out of a bank, it triggers a ticket that says, well, what was it spent on? Well, we either need to know, either Google has to know about it, or the bank has to know about it, or the system has to know about it. You have to be 1099, and they're going to want to know what it was spent on. Then they're going to trace you and track you for what you spent that money on. That's just the tip of the iceberg as to why you want to be your own bank through a life insurance policy. I was trying to make that simple, and I know I kind of made that complicated, but it's the difference between borrowing from a bank and borrowing from a life insurance policy. It's different.
Yes, because in the insurance, in the deal with the insurance company, the policy is the collateral. That's the secured item. Thank you very much. I very much appreciate you. Thank you so very much. I have an angel that lives with me. I don't know why, but I try to treat that angel very good.
Yes. Yeah.
I
have yet to meet your angel because you hide her away and don't share her with anybody.
I'm not really into sharing. Like Alan, I'm more of a type of person that says, hey, can I have an Oreo cookie? I'll go buy you your own thing of Oreo cookies. I don't have to share mine.
You got to bring her to Vegas so we can all,
Well, there was universal things going on then. Like I've offered her every time, but universe has another plan for her, and it's never like a really good situation for her. Cool. Yeah. No. Yeah. Well, we just got the better than a beater with a heater that now I can go on tour everywhere I want. Like, dude, the map's starting to fill up of places we're about to go.
Yeah, that's right.
Yeah. No, that's a good breakdown, Alan. That's a real good breakdown. Because when you put the funds over into a policy, a contract, and it's got by contract, it's growing because of the compounding interest, right? That's the agreement. And and that right there is why the insurance company is 100% willing to lend you that money, because you have a policy, and the guarantee for them is upon your graduation day, whenever that is, and you go to the awesome energetic fields beyond, they get their their money back plus interest. And then after that, then the beneficiaries, whoever that might be, in my case, it's an angel, they get the rest of the check. Of course, I want my angel to have the full check. So I'm trying to have all my loans paid off, but it could happen any time. I don't know when I'm going. But as opposed to taking that $10,000 and go sticking it in a bank account, and then I use some and now it's gone, all opportunity is gone now. All of it. I didn't even get interest on that.
Yeah.
Zero, like you said.
That's right.
If you focus on just some of that, going, okay, if I put it here, it does this thing. If I put that same money over here, can it do the same thing?
Yeah.
Okay. Which one gives me more options? Because in reality, the options we have at a standard institution are borderline non-existent, in my opinion.
Yes. That's what I'm
comparative to what I just shared with you folks earlier. That's one great example of me having the control of the banking function in my life versus JP Morgan and Chase and Friends. It's a beautiful thing. It's a very beautiful thing.
It is. And there's another thing too that we haven't even mentioned about the whole thing. Is the bank going to give you a death benefit? No. I'm not going to do any of that for you.
They're going to probate you.
Right. Is it right? Is it like, who's going to end up with the money, and it's not going to be your kids, right? So that's another thing. All that inheritance from life insurance is like sacred money. It's like, whoa, that takes an act of Congress to get anybody to get their hands on it, including the system. It's almost impossible for them to come after that money. The other thing is the tax benefits. You're not going to get inheritance tax, to the gills when they do, when the policy does pay out. Is it a giant policy? No, typically it's not, because that's not what you're doing here. You, thankfully, have learned how to use money to make money. That's what you've learned, and we're assuming that that's the skill that you would like to have. Yes. Well, once you learn how to make money with money, then you need some money, right? Or you need to have a steady income to where you can put the money in a place to where now I have it at my access when I need it, because I'm now the bank of that money. So now I can use that to learn from Alan, Simon, or whoever else as to, hey, what do I do with that money? How do I make a little side hustle? How do I make a buck on the side? What are we going to do here?
Let's start with just a side hustle. Let's start there. Start with go to YouTube. How to flip stuff online. That's like a total common thing out on YouTube, Alan. Right. Now here's this great thing. Okay. If you go the traditional way, you pull money out of the bank you currently use. You buy some stuff. You're trying to flip it. It doesn't sell. It's a flop. It's over. Well, you got the thing, and now you're out the money, right? Okay.
Yeah.
Well, the other way, you borrow against your money that's compounding. You do the same thing, buy the same things. It's still a flop. Okay. Well, you have an agreement to pay yourself back with interest. You're okay with that. You're like, hey, it was a bad deal, but I'm still bringing in the money on the back end with this interest. You're really going to win. And then maybe 10 years later, someone might say, oh, that's vintage. Here you go. You want it? I'll sell it to you.
Right, yeah.
Gotta
have that sign, yeah.
But it's the thing of psychologically of waiting for those things to sell, and you get impatient. You're getting emotional, right? So we're talking about possibly a bad business deal or a bad business mistake we're about to make. But we don't have to have the never-ending financial loss in that deal over here with the IBC versus traditional.
No, we don't.
No personal guarantee type stuff where they can take everything you own. just because you missed it out. In fact, I'm so glad I'm talking about this. Alan, did you happen to watch? I know I'm jumping around here a little bit, but did you happen to watch that video I mentioned on the Nelson Nash Institute YouTube channel? Did you happen to check
I
that one out?
certainly
With Carlo?
did. I
Did you?
didn't watch it. I listened.
You listen?
I did.
This is a great explanation
with Carlos.
with
Yeah.
Carlos. Yeah. Oh man, talk about a home run hitter on explaining this at the business level. At the business level, and you don't have to know business to get this. Like it's he does a fantastic job articulating this, and in that he really shows what I'm trying to bring to light. You borrow from a standard bank over here to do a deal goes bad, you're not doing so good, like really not doing so
That's
good.
right.
You'd use the infinite banking concept to do the same deal. It still goes bad, but the bad does not last as long as it could over here. In fact, there's probably a guarantee over here that it's going to last a very long time versus over here. And in Carlos's a video that he does on the Nelson Nash Institute YouTube channel, man, he shows the death trap, and it was relatable because we've all been our own death traps.
Yeah, and what they're going to do when you take a loan from another bank, and it's a great business opportunity, you and your buddy are going to, whatever, start a detailing business or something. Oh man, we got this, we're going to make a bunch of money. And you take a personal loan or business loan from the bank and things go bad. Your partner runs off with a bikini model, whatever, and the next thing you know, you're like, well, now I'm in debt. I borrowed 20 grand from the bank. They're going to ruin your life. Period.
Yeah.
That's what they're good
because you're in a rock and a hard place and you got no way out.
Yeah.
No way
you
out.
owe the bank 20 grand. They're going to ruin your credit. I mean, good luck ever getting a loan again. I mean, at least for whatever it is, 7 years until it comes off your books. It's just the whole system is front loaded for you. You've got to instantly start. That's another thing too, guys. If you start a business with your own capital, there's actually nothing that says you have to pay the money back that year. You don't have to. Now, it's in your best interest to do so, and you're going to grow your account at a rate that's going to blow your mind, and I would do so if you could. But if you run into hard times, it's your bank. Banker didn't get paid this month. Hey, baby needed shoes, whatever. All of those options exist with this, and it doesn't exist in any other way that I can find. And it's amazing, really, what it is.
You got a couple good questions over there in the chat, Alan. You got Wayne Littlefield. He's got a great one there. And also Hydro looks like he needs a little, Hydro needs some clarification there.
Why don't you take Brother Wayne's question? What is it? Should we highlight it?
Yeah. Throw it up on the screen.
There we go.
Always. This is a school in the making.
That's
can you start a policy for one amount and then add more money to grow to a larger policy? Okay, so let's paint that picture. Can you start a policy for a certain amount, meaning, hey, insurance company, I would like to first start out a $250,000 life insurance policy. Okay, so right there from the get-go, it started. Can I go to renegotiate with the insurance company at that point to say, hey, can we do $500,000 instead? As far as I understand, you can't do that because the contract's already in play. But here's the workaround, Wayne.
Yeah.
Earlier in the show, I mentioned the acronym PUA. And Alan said, hey, what the heck's that, Simon? Paid up additions. PUA is you're buying in full micro size amounts of death benefit. And you have a cap on how much you can acquire per year within the policy agreement. An example of this, mine is $10,000. I cannot buy any more than $10,000 a year of PUA. Now, what happens here when I buy extra death benefit, an example, let's go back a little bit. $250,000 policy at the beginning. That's my death benefit. Okay. Now let's say a year has gone by. I've met my minimum obligations. I've met my base, but then I was able to buy $10,000 worth of PUA over the course of that year. That's extra death benefit. So now instead of my policy being worth on graduation day $250,000, that now it's worth $260,000.
Yes.
Right then. Okay. So now it's grown, but that's not including other variables in the specific policy that I have, where mine's a mutual dividend paying. So I get compounding interest. Awesome. I also get dividends once a year. Then again, I can buy PUA. Just in simple terms, I'm not going to go too deep, but can I say I don't want to do a $250,000 policy? I want to do a $500,000 policy. No, whatever the amount that I agree to, and the insurance company agrees to in regards to how much you're worth, or your what's called your insurability, meaning how much do you bring in a year, what do you do, etc. All the bean counter variables.
Bean counter.
That's bean counter, and that's not my wheelhouse. That's definitely not my wheelhouse. I'm not an insurance agent, but I get it.
We should expand on that a little bit.
Wayne,
what we mean by that bean counter part is all of this. If you only make 40 grand a year, okay. But if you don't have any bills, okay, you're probably not going to, even though you don't have any obligations or whatnot, you're probably not going to be able to qualify for a very large policy to begin with, because it's
25%. Alan,
yeah,
25%.
Right. So it just depends on how much money you make, or what your liabilities are, and how much of a financial risk you are. In other words, Wayne, I know that you're doing pretty good in life, so your policy could be. I would advise. I'm not advising. I would suggesting that you might want to think about biting off a little bit more in the beginning than you can chew. If you only want to stick to one policy, maybe that's a way to go. But
that's what I did.
Also remember, Wayne, if you qualify for one of these things at a pretty decent chunk, that means you can get another one. Now,
let's talk about that. Let's talk about get another one part.
You can also insure your wife or your son.
That's another option to get another one. Yep, absolutely.
Right.
Absolutely.
So that's another aspect. That's another way to go. I think what Wayne's leading to here is what happens when I get a windfall, which is a situation that a lot of us XRP people are hoping is going to happen one of these days.
Anybody in crypto, it's there's a chance for a windfall. So there is a way to do that. And that would be something that I would actually, you know what, Alan, I think it's possible, but I think when we get we can have JV and he can expand on that. Also, Scott Champman, we could have Scott Champman on. He's one, and we can expand on that lump sum thing. And I think that's a good topic to talk about, is the lump sum. But it's possible, yes, absolutely, very doable.
So we answered that question for do you see it? Yes, you can have multiple. You can have dozens of these things.
Here's an example. Go ahead. When
XRP goes to $5 and you cash out a bunch, and then it goes to $15 and you cash out a bunch, and then when it goes to $50 you cash out a bunch, you may need to get a policy each one of those times. Perfect. Good. That's a good place in life to be. The windfall is a little trickier to put in, but you can pay whatever you've borrowed quick with it.
Here's something that I have available to me within my policy right now. I also have the ability to set aside up to 30. Now, this is for me. This is my math, my numbers. Okay. Just because I say a number here doesn't mean it's gospel. Okay. I just want that abundantly clear because everybody's different. Everybody's
You're
different.
Being recorded. Yeah.
That's okay. I can be. Why? I said gospel. Is that a bad word? I can't say gospel anymore. Are you kidding me?
No. I said you're doing math and we're recording you. So yeah, it is. No, I'm kidding.
Here we go. Okay. So part of the policy that I have, my contract, I'm able to actually set aside up to $30,000 in a interest bearing account with the insurance company. Now that part's taxable over there. That gain I get, that doesn't get me out of the taxable event zone, but it's a beautiful place for me to go. Cool, there it is. And then once I give the insurance company permission to start pulling funds to meet policy obligations and more, I can have them do it from there and just have them go that way. Right. It's just
Yeah.
another option to
Yeah.
to cubbyhole some funds to, because when windfall happens, we're all going to be there. What do I do with the money? It's like, cool, I got a policy, great, but
Yeah.
there's going to be
Now
that. Yeah, there's going to be that hold time, right? There's going to be a moment that could be 6 months, could be a year. I don't know. Depends on your situation, but the money's going to be stagnant for a minute while you complete the process to get those funds into the places that you want, policies, et cetera, et cetera. Alan, before we go to this question right here,
what do you got?
When you're talking about Wayne's question where he can get a policy on other people as long as they agree with it, that's one way. But I mentioned insurability. Okay. As my income increases in my life, as my earnings increase, so does my insurability, the amount that the insurance company will be able to do, or what that's willing to do, rather. And typically they don't like to go over anything of 25% of what you bring in, of how much you pay per year.
Okay.
Cap.
Yeah.
Oh, per cap. Okay. So, that's, I really like that. I think that's great.
I did too. Yeah.
It keeps it conservative, not overdone, a little uncomfortable, but I can still hit home with it because I'm disciplined.
And from what I understand, it used to be higher. The levels used to be higher, and the man, if you will, keeps trimming away at this thing to make it less beneficial for people like you and I. Which,
all right. We can,
yeah, we can still make this thing work big time, easy.
Mm-hmm.
Yeah.
How do you use question? So the higher your monthly life insurance premium, the less time you have to wait to build it up and use it. Okay, so
that's two different questions, but
it is. Okay, so first off, it doesn't have to be a monthly payment. In my situation, it is, because that's what works for my budget, and that's the insurance company gave me that option. Everybody's different. Now, the higher I pay monthly in my insurance premiums, well, of course, the better. I'll be able to use funds. I'll be able to use more funds later because I'm going in heavy. But just because I have higher premiums in my monthly payments, that doesn't negate I have less time. I have to wait less time because there's two parts here. There's the death benefit side. As it grows, it creates cash value. Okay. Yeah. There's the PUA side that when you buy, this is the instant part, arguably, Hydro. When I buy extra death benefit, I've paid in full. So that means I can borrow against that, paid in full, which directly affects the cash value of the policy in that moment. Okay.
Yeah.
And I know that's a lot. So go back and watch that part, like I just said.
Yeah.
And then you can borrow that. Then you can borrow against that cash value. That's what we are collateralizing in that moment.
That's right.
For the insurance company to say, yeah, that's cool. We'll lend you the funds that you want for whatever you want to do with your life. So the faster you build that up, yes, the sooner you have more money to borrow because you've put it in there.
Yeah, that's right. We have so many great questions.
It's all right. I got all night.
This one's good.
Can't front load the policy with extra cash, so you have to immediate more dollar loan. Oh, can't front load the policy with extra cash.
No. Okay. First of all, what is it? 30 days, right? With most of these companies, within 30 days, you can borrow, I believe it's up to 90%, Simon, against what you've deposited.
On the cash value side.
Yeah, on the cash value side, yeah.
On the cash value side, it's cash value. That's what you're borrowing. It's sooner. Yes, 30 or there's a 30 or less because mine was actually fairly quick. I had to wait 21 business days. So that actually pretty much pushes you into that 30-day punch. But after that, I was good to go. And I did PUA. I did my minimum obligation, and then I threw in an extra payment out there once the policy was enforced. That extra payment, meaning that payment went to PUA. And then I had to wait for that to clear on all sides. Mm-hmm. Then I could execute a policy loan, and I did that because I just wanted to see how it would work first, right? I just want to make. I need to know the timing because I have bigger plans than I'm going to utilize this thing for. So
this is another great question from Wayne.
Oh, wait! First off, Alan, do you have one of those?
A 401k?
Yeah.
No.
Oh, okay.
I have actually never had a 401k. Well, maybe back in the Stone Ages I had one of those, but no, I don't.
Whoa, okay. Stone Ages, Fred Flintstone. Yeah. I didn't know the 401k went back that far.
I don't think it did either. Actually, I actually had a union job at one time, so yeah, it was. Anyway, I have a real good answer to this as to why I don't think people should have a 401k, and it's quite conspiratorial, if you will. The 401k, the entire thing, the man who created the 401k, I don't know if you guys have ever listened to his work. He's still alive. He created the whole thing. He's a great man. Even he doesn't believe in 401ks. He's written 2 books about it going, yeah, well, they bastardized the whole thing and they ruined it and they manipulated it. And the whole thing was just a Ponzi stock scheme. So that's his opinion. He created it. Now, the biggest problem that 401ks have is fees. They're bouncing your account is being bounced around like a ping pong ball, and they just turn, and it's called churning, and they turn and churn your account, and Wall Street gets really, really wealthy because you can imagine how many people are paying into these 401ks and how large the pool is. So the pool perpetuates a larger pool, which enables them to manipulate systems, trades, accounts, and purchasing, which makes it more and more difficult for the little man to try and make a buck in the stock market because these massive pools of 401k leverage is out there and they're moving things around and they know they're about to do it as to the benefit to the house and the broker first. Remember that. You are last on their mind. They didn't create this for the people. I want you to understand.
Sounds like it's eerie similar to something else that's kind of that way.
They created this entire thing as a mandatory. Okay. Oh, wow. Well, our IBM will give you, 20 cents for every dime you put in or whatever it is. Yeah. Okay. Great. Sometimes those can be decent. But even if you believe in you rather having a 401k, and I'm not giving financial advice here because you have to make your own decisions in life. That's not up to me. But even if you believe in a 401k, I would call iTrust Capital yesterday because you need to be in control of what you're buying or not buying every hour, if you know what I'm talking about with those fees and churning. These people will, by the time you get your money, you could have made 30 years later, you could have made 3 times that amount if you simply bought.
Easy.
simply bought gold or silver, for God's sakes, you would be doing better than what those accounts are paying 30 years later. It's sad. And then if you take it out early and that whole thing and it's penalized, why are you? Let me ask you, why are you penalized for taking your own money out?
Because mom and dad don't like it.
Right. It's a fee that they can charge you. That is just like, what? This is my money.
Right.
Oh, well, that's like telling somebody with a checking account, oh, well, you haven't had your money in this checking account for 30 days yet. Like, what? What? It's my damn money.
Well, I'm sorry that you put my money into something that you can't get it really quick, but I got to go. So pay the tab, Phil.
Right. Yeah.
I would like to answer that. Do I like this better than a 401k? Yes. Yes, I do. Absolutely.
I just think I explained anything's better.
Yeah, you did. I just want to throw my feather in the hat. I've done my own writing on the wall with looking at a 401k. The fact that I have money that comes out of my check that I'm not taxed on, and it grows somewhere, and I can't touch it when I want to. That's
right.
That's a problem. You know, yeah, it's a problem. So, anyways, yes, I love IBC, Wayne. I do. I love it. I'm so grateful. Really grateful to Nelson Nash that this is here. This is my platform. This is my platform that I'm going to be doing all my business with. This is my foundation. I didn't, it's my foundation.
There's something we probably will say every show. I say this a lot, but I really believe in this as much as anything I've ever learned about finance in my whole life. I think I absolutely believe there's not one human being on the planet that couldn't do well with this. I should rephrase that. If you have any ability to be conscientious with your money, or you want to concern yourself with your money, and you have some discipline and some diligence, I would say every human being should have this. In fact, this should be required banking right out of high school. I mean, if they cared about the people of this country in Canada, they would actually require that you know what this is coming out of school. It's that beneficial, in my opinion. Are they ever going to do that? No, because they make trillions of dollars a year off fees, off banking.
Right. Alan, we can't just have people go out and stop working a standard 9-to-5 and do what they want with their lives and make an obscene amount of money and wealth building. We just can't have that. Table is full,
right,
with family members. You're not one of them.
Who's going to be the hamster on the wheel? For God's sake,
Somebody hamster.
Be the wheel.
Take care of that hamster.
Yeah. No. Okay. I do not get to choose where they invest, but I will tell you.
That's in reference to your iTrust statement.
Yes. Yeah. You don't get to choose. You don't get to choose what you do with it. You do get to choose when you withdraw from it and use that capital to do whatever you feel like doing with it. Okay, so that you can do, which is even more freedom than iTrust capital in that sense. However, if you're talking about the companies in particular, which I guess you're not, the most successful trading companies in the world are all life insurance companies. You can look it up. There's nobody even close. That nobody returns annually. The only companies in 2008 that made money, life insurance. The only companies in 2000 .com bubble that made money, life insurance. It's because the math is on their side. They've hedged it from both ways, and you thankfully, are going to be on that team. And
Absolutely.
you are going to have the tax benefits of they've been doing this for a couple of 100 years. They know how to do this. They've set it in stone. It's all regulated. It's all works for them. We don't have to conquer the world like we do with crypto to get everybody to understand it all. People that know how to make money, like we talked about this, right? Bully. Who is Bully? Right? What was your homework last week? You're supposed to figure out what Bully is. Bully is bank-owned life insurance. You look.
Bole. We like bole. When we're the bank owner.
Look at Cole, Bole, and Mole. The three Mole brothers.
Oh, here we go. Now that song's going to be in my head.
When you look at corporate-owned life insurance is the most profitable thing on the planet. That's more profitable than Bole. Because all corporations put their working capital in it because it makes money, because it doesn't get taxed, because they can borrow against it, because it works like a bank. The whole thing is in your hands. And thankfully, because the great brain on a man by R. Nelson Nash, Simon and I get to sit here and help you guys figure it out like we're figuring it out together. It's great. Good stuff. What do we got for good questions in there? That was a good one.
Another one. There's another one by Atlantic Living, a little further up.
Oh, Atlantic is in the house.
Atlantic's in the house. There we go. Yeah. Are there any restrictions or differences with Canadian and U.S. regarding everything you're discussing around infinite banking? Yes, there is. And that is the legislation set forth within how the insurance companies can do business. Here's one just fun fact. In the U.S., the bean counters use a scale of 120 years to go into their formula to figure out how much insurability you have. Right. Over in Canada, it's 100 or it's 99 years. I believe it's 100. Okay.
100, yeah.
It's 100 years, right? So that's just one. Yeah. Yep. That's just one thing that's difference. The difference between the infinite banking concept, in my opinion, can be utilized in a number of different ways, even with yourself. I've kind of done the infinite banking concept with my mattress money. I've done that. I didn't get compounding interest on my money while I was sitting underneath my mattress. Okay, that's a loss, oops. But I was paying myself first, and I was paying myself back with interest anytime I went in there. So that's a component of the infinite banking concept, because I wasn't borrowing from a credit card. I wasn't borrowing any line of credit from any other institution. I was borrowing from my own personal private banking stash underneath my mattress. But there are some regulatory issues. Meaning, when I say issues, not problems, I'm just saying it works like this in this jurisdiction, and over in this jurisdiction, it works a little bit more like this. There are, if you're up in Canada, there are IBC practitioners that are authorized IBC practitioners that are in Canada. There's a plethora of them. They're really smart individuals up there as well. So,
and we're eventually going to get you a list of who all these people are, and we're going to be able to get you to contact them through the Institute, we hope. And because I don't want to see anybody in this group buy life insurance from anybody that is not part of Luke, here's the answer to your question. We can put that down on the link.
Yep. Scott Champman.
Yeah.
He's still He's selling that book for $17.76 right now over on
Really?
his site. Yeah, it's a good deal. I think it's only for the next 24 hours. But I was like, oh, dude, it is a great deal.
Yeah.
I already put that link in the chat. If you guys wanted a book tonight, wouldn't be a bad way to go support another IBC practitioner, unless Alan's got his Amazon link. You got an Amazon link yet, Alan? I didn't think so. No. Yeah, no, I don't either. No, but it's a good book, folks. Definitely get it. Definitely read it. Listen to it. I was listening tonight again, actually throughout my day while I was driving my little better than a beater with a heater. Actually, I named the car. I call it Yasui.
Yasui?
Yasui. Yeah.
Okay, got it.
Yasui is Japanese for cheap.
Got it. Nice.
Yeah.
Nailed that. Yeah.
Yeah. What else we got? What else you got, Alan?
I got this one. Love Peaky, by the way.
Peaky. Is Peaky blind? Yeah. I could be wrong, but I believe that there is also a determination based on savings, that a certain percentage of savings on top of the income is allowed to be put in. A determination based on savings. In regards to savings on what?
Yeah. Yeah, yes. You get to decide what you pay it back. Yeah, that's right.
Yes.
Like Simon randomly picked 20%. He he's not required to even pay any interest back. Just I will tell you that you should do that.
Yeah.
The math just pencils out when you do it.
Yeah, no, I totally want to do that. My banking system, my business, because it is a business, is designed to grow and earn money and grow again and earn money and grow again. I have to participate in that process, just like any other venture that I do. I too have to help feed the machine and make it grow.
Yeah. Peaky's talking about self-directed. Yeah, that's what I Trust Capital does. There's a couple of I've known gosh, what's the other company? I really recommend those guys kind of over iTrust. We went with iTrust Capital personally, but there's another group. God, they've been around forever. I can't remember. They're really good guys. They just moved to El Salvador, by the way. They moved to El Salvador.
There's Wayne's got another question. So does Luke S. in regards to legal structures. Luke has a question there. Yeah, I recently started a holding company, LLC, for my digital assets. Can you give a good example of how to use IBC through my LLC? I can, but Alan,
you want
to get out the big baseball bat for this one?
Yeah, right. There's about 1 million things you could do on this. Simon and I talk about this a lot. This is kind of weird, but I really want to interject something right here because I'm going to go off the question just a little bit. Like, we're taking random questions here. When this is kind of how do I put this?
Introduction.
There's levels, right?
Yeah.
There's level 1, 2, 3, 4. This is a level 4 question. This is not a level 1 question. This isn't like, hey, I need to go get some blood drawn and get a life insurance policy for myself. By the way, if you're younger, many people don't even have to have your blood drawn. But this question is level 4 because there's 1 million things you can do with an LLC. By the way, we're working with some trust companies as well. You could build a trust and you could also build this IBC account. After that, it's infinite what you can do with the finances of that product. So I'm going to go real broad on my answer on that. How creative are you going to get?
Yeah. Keep it broad. I would say keep it broad.
Yeah. How creative?
Don't stifle the creativity. Yeah, exactly.
Yeah.
Love the creativity. Can I give a little example on that of how that might play out for the level 4 question?
The stuff you and I talk about. Yeah.
Yeah.
Sure.
Okay. So here's how Luke. Here's a way that you could use IBC. It's not the way. It's a way. So you could essentially, the company could take out a policy upon yourself. Okay, because you are a key member of that company. And so now the company would be paying funding the policy, and then because the company is the owner of that contract, that asset, arguably, it could then borrow against that policy and then go get more assets like the ones you got right now.
Yep.
That's a winner. I'm going to leave it at that.
Yeah. No, that's well said. That's one of the dozen ways that you could do that for sure.
Can I go shotgun with you for a minute on the show while I've got a wide open pen about all the pigs coming out.
Okay. Oh, we do?
Yes. Unfortunately, the gate came down, the one that you Jimmy, and I'll just sit. Let me sit and I'll chat.
Okay, we're going to have a guest host here for a second. And yes, thanks, Professor. Perpetual assets. Call Gus and
yeah, for the 401 rollover crypto thing. Yeah, that's a play. Yeah, that's a good play.
Yeah, for sure. Those guys are really good. They take good care of people. Elizabeth's going to join in as I have to go corral some pigs real quick.
Sorry about that. And I've got the so-and-so, he thinks that's his job.
Good info, nice other crypto.
Hello, here we are.
Are you going to leave him in here?
You can drag him back in here. What are we talking about? Hello.
Oh, hi. Hey, how's the there's some questions here, some good questions. We were answering Luke's question there.
Yeah, Alan's are great on the financial strategy a lot and the thinking outside the box.
Yeah. Well, I mean, when you're not in the box, it's amazing what you can do outside the box. Mm-hmm. There was a question by Two Down Hilltop LTD. Would you mind highlighting that one?
Oh, sorry. Yes, let me get on the ball here. LTD. Yeah. What does it say?
Yeah. It says, Simon,
do you see what interest rate? Okay. Got it.
Okay. All right. Simon, did you see what interest rate they were paying you for the funds that you did not borrow? So when you're talking about the funds that I didn't borrow that was still over there in my first off, are you talking about the funds that are still over the policy or the cash on the side that I had? Because if you're talking about the cash that I had on the side,
I think they misunderstand. I think this is a big misunderstanding. So what happens is, you remember, because you have the policy plus the rider, those two things are earning interest. You borrow, you leverage against the cash policy part of that two-part thing. So you actually pay interest to the insurance company over here, and you're still making interest compounding on the policy plus.
I am going to pull up an app.
Cash value.
Go ahead. Yes. Let me draw that out.
Try that.
I'm gonna try to. Let me find my cool
always
apps.
More complicated. Mm-hmm.
I know. Like, I just had to draw it out on a piece of paper. Where's my paint? There it is. Paint. Let's make it big. Do you got something cool for me to? Okay.
I've got pig hunting dogs trying to hunt pigs.
Okay. So let's go like this. We're just going to draw. Yeah, we're going to draw this.
You can share probably, maybe.
I can. I'm just drawing real quick. Sorry, folks. I'm trying just to make sure I like.
Maybe LTD. Where Hilltop could further clarify. That's right, XRP peaky. It's leverage. So you leverage against your cash policy. The cash policy is still sitting there. Now, if you don't pay back, they'll just take it later. You don't have to pay it back until it never gets back to the insurance company. At some point, you will pay it back.
Go ahead and I'm sharing my screen.
The thing is about the Becoming Your Own Banker book that we are going to get into, one of the chapters we will get into discusses responsible money management. And you don't want to just be taking the cash value and then not paying it back. You want to be able to pay it back so you have access again and again and again to that money. And if you're just going to take it out and kind of default on your own loan, then that's not going to be good.
I have a
everyone's having a lot of fun with, there's 2 piglets, so they're just right about the right size.
I have a screen share to do. Would you mind adding it to the show?
And then I see it. Yes, I can do that. I can do that.
Perfect.
Add to stage.
Perfect. That's good.
Oh,
and then let's get rid of the we can leave that. That's fine.
Get rid of the Hilltop. Okay.
No. We can leave it. We can leave it. It's fine. It's relevant.
I can.
Okay. We'll just leave it. Okay, so what we have over here.
Interest rate you get from the insurance. Here, let me add his clarification.
Just wondering what the interest rate I get from the impairment on any cash that sits there unused. Okay.
That's the policy plus rider.
Anything that is that's over at the insurance company that has been already allocated by you to the policy, you're getting interest on all that money. Okay. So I'm going to draw this out real quick. Just real quick. Okay. So this is your death benefit pile. Okay. I should have drawn another one over here. But this is your, we're going to call it your cash value pile. Okay. And this is you. That's a horrible you. Here's how this works. We have a policy. Okay. I'm just going to do over here to not lose everybody. And I'm going just off mine right now as it sits. I started out with a $25,000, a $250,000 policy. Okay. That's for the length of my life. Okay. That's what we started out with. My maximum that I can fund this policy is $15,000 a year total. How does that work out? That means per year, I do have to meet this $5,000 death benefit side obligation every year. That's a horrible, horrible dollar sign. It's all right. Sign of the times. What happens is there's this cash value that grows because of the interest rate. I'm getting interest on this money. My interest rate, I don't have my policy in front of me. I believe it was 4%. Okay. Now, so there's $5,000, 4%. Now I have this cash value, and I know I may lose a few of you over here. By this continuing to grow year over year, it can contribute to the cash value side of the policy, a section in which we're able to collateralize with the insurance company. Okay. But I can also, out of this 15,000, I can throw a maximum per year, $10,000 over here per year. So let's just say, and by the way, this is getting 4% as well. It's getting 4% as well. What I'm doing is I'm saying, hey, insurance company, I would like to borrow against this 10,000 and get a loan. Okay, so I'm gonna give the rights to the insurance company to take their $10,000 that I borrowed out of my policy if I graduate. As in, if I got hit by a bus tomorrow, I have an outstanding loan with them. Before this death benefit payout goes to my wife, they're gonna minus $10,000 right off the top. Okay, but I'm still breathing. I'm still here. So I'm going to pay back that loan. I'm just going to do loan here. So I took a $10,000 loan. 10K loan. Oh my gosh. I really just need an old school whiteboard. So I have a $10,000 loan. It went to me, but I have to pay that back. So when I make my payments back, whatever that is, remember, I can choose how much I would like to pay over an extra period amount of time. It's up to me. I get to choose all that. The insurance company is like, you can pay us whenever you want. When you graduate, pass, right? We're just going to take that out of the check if it's outstanding. This all right here, even when I'm paying back my loan, it's still compounding. It's uninterrupted. I'm just paying my loan back. Does that make sense so far? Yeah, loan equals leveraging. Exactly. Absolutely. This is the leverage. I'm using my asset that I created to leverage a loan, borrow against it. And now, what am I going to do with this loan? Well, I might go out and go get me some more of this. I might do that. I might buy some more XRP. And then over, say, 10 years, I'm going to pay back that $10,000 plus interest.
We're talking about the interest rates on borrowing and leveraging and things like that. And Simon's got a whiteboard going.
Yes, and paying back adds to the compounding incentive. Well, it depends. Like mine's non-direct. It's uninterrupted. They don't put a pause on that portion I borrowed. That still stays going. And for every dollar that I pay back to this 10K, it's freed up in my cash value that I'm able to collateralize again. So let's just say I did a $100 payment. My first went over to the loan. Okay, minus interest, I have now freed up that amount over my cash value. Guess what I can do again? I can borrow it again. Not quite instantly, but within days of everything clearing. And I can keep on doing that. The same money goes around and around. That's literally what I just wrote out here for you guys, is about a level 2, arguably a level 3 knowledge base of what I just wrote out here. Okay. I'm only articulating to show you when I contribute every month to my death benefit side, my base, and then throw any extra money I got throughout the year, I throw into my cash value side, PUA, that directly is realized as cash value. I can only do up to $15,000 a year.
Yep.
But these two guys, they are compounding all day, every day. Loan, no loan. That's with my policy specifically, because the agent that I use is an IBC practitioner that knows what the heck they're doing, and they have more IBC practitioners, authorized IBC practitioners, and they know what they're doing. I literally have, in my opinion, I have a team behind me, and I just don't know it, but I know they're there. It's its own community, in its own right, So my compounding continuously grows, which over time, so does my cash value. I could just do death benefit. In fact, I believe Nelson Nash, he didn't have this extra PUA side that he could go buy extra death benefit. He didn't have that. He just had this side over here. and that grew the cash value, and he could borrow against that. But that's what we're borrowing. We're collateralizing the cash value or leveraging. It's not removing it from the policy. Yes, Peaky is on it. Peaky looks like he drives. Probably listens to a lot of IBC. So I hope that's relatively clear. We're going to go over all this multiple times. I have lots of pieces of paper still that show this breakdown to show me the cash flow of how things work. So one of the main reasons why I did that is because there are, don't do that. There are I'm wearing 4 hats in one transaction in my home banking system that I have going on. Each one of us do. Yeah. At least it's very much important to know what you are in each step, because you technically are a different person doing a different action in that process. But that's in the details. Don't let the details bog you down. No. This right here is a beautiful play that anybody with even small money can start this process.
Yep.
Totally.
Yeah.
No problem.
The only real requirement, in my opinion, is you need to have a pretty steady job. You should have some solid income, and you should not be completely tapped out, because this is essentially a savings account. That's essentially what we're creating.
In principle, sure, absolutely, yeah. You can
so if you don't have extra savings, it's out of your budget. Like, how are you going to pull this off?
Easy.
You really
trim the fat.
That's another.
Trim the fat. Free up the money. Turn off your Netflix for a year. I'm telling you, you're not missing much. Netflix ain't putting out quality lately. Just saying.
No, and if you listen to what the founder said the last couple of days, man, I was just like, what are you talking about, dude?
He can talk about whatever he wants. I'm all about business.
I was really.
You got to brainwash the masses.
Right. I was just like, come on, man. What? Yeah. There's some really sick puppies out there right now. And then, anyway, don't get me started on that.
Don't keep it.
Right.
Wayne, I'm not trying to tell you what to do, but I already did that with mine.
Yeah.
I don't contribute. That's my own I have my own personal reasons for it. And if we ever chat again, which I'm sure we are, you got my number. I'd be more than happy to tell you my story about it.
And Wayne, you're smarter with your money than 90% of the people out there. From the conversations I've had with you, it sounds to me like you need to, take a more active role in your 401k.
Yeah. If there's a way to move it into a better position, then, always a good thing to look into. Oak asks, what kind of interest does the policy earn? Depends on the company, but we're talking 3 to 4%. You might go, well, that's not very much. When you see an illustration of how it really compounds over time, and it's guaranteed.
Yeah. Haven't missed in hundreds of years.
Yeah, not missing dividend payments in 100 and 200 years, depending on the company.
Pretty secure.
Yeah. That's the best deal you're going to get in this world, in my opinion. Right. That's how I see it.
It's not even mentioning dividend.
Yeah. No, I'm not. We're just talking interest. That was the question. Dividend's a whole different thing. Because it's just more money on top of more money that you're able to utilize, leverage, and etc. Later, more money, no problems. More money, no problems, right?
I really want to stress. The illustration showed it so perfectly. There are tools out there for all of us. You're not alone. You can do this. This is not difficult. Most of you already understand the principles behind money. So once you get free, once somebody takes the handcuffs off of you and you're like, well, I can do that? Oh, you mean I can be my own bank? Well, I've got 10 grand. Oh, okay. Or I've got $1,500, whatever it is. Shoot, you know what? I could even make a solid argument for somebody selling a chunk of their crypto right now to open one of these accounts, because you can buy the crypto right back, right? You got to get your foot in the door of this thing. And that's really because it's compounding. And it's one of those things that you can't believe it's that good to be true.
Yeah.
There's a
man. Yeah.
If you go to the Nelson Nash site, Nelson Nash Institute, I believe it's called, isn't it?
Infinitebanking.org. Here, I'll put it in the live chat. Go ahead, Alan.
For the YouTube videos? That's
I believe it is.
I'm pretty sure. Oh yeah. Anyway.
YouTube channel. Yes, I'm sorry. I thought we were talking about the site itself.
Yeah. The guy they have videos and they're pretty professionally done. They're really quality stuff. You guys should really go there and check those out. But I looked at them like 4 months ago or 6 months ago, whatever it's been, time goes by. I looked at a couple of them the other day again. I highly recommend show number 2. If you just look at the way that guy laid that show out, I want to say there's like 8 to 10 benefits to opening this that you just can't believe they're just too good to be true. And you're like, well, that can't be real, and that can't be legal, and that can't be right. And what do you mean it's tax-free? And I can't even, and my kids aren't going to have to pay tax when I die. Like, all of these pluses are listed for you in episode number 2. And I thought it was such a brilliant show. I watched like 4 or 5 again the other day, and I was like, 2 really stuck out for me as quality 20-minute video. Unlike that.
You're right. You're correct, Alan. It's Nelson Nash Institute, at Nelson Nash Institute on YouTube. I just put the link in the chat. Go over there. It's great. Really good stuff.
And those are the people that this show recommends. Those are the people that started this whole thing. I'm not ever recommending you go see your brother-in-law who sells life insurance. I'm not going there. These people, I've heard these people talk in videos, and for 20, 30 years now, they've been writing books about it. These people are real people. These people are not out to get rich. They're out to get you rich. And there's a big difference.
Not even rich. Out of this system, in your life, in your hands, growing.
Right.
Growing.
Right. Yeah.
Right. As it should be.
And it's really kind of amazing, because Simon and I are in a blessed position to actually meet some of these people going forward. We've spoken to them on the phone. They're real people. And they were concerned. Listen to this. They were concerned about who we are.
Yeah.
Okay. Because they have a standard. They have a standard in which, look, we've run into some bad crypto people. We need to figure out who you two are. What kind of sharks are you guys? Because, a lot of those crypto people are just sharks running around stealing people's money. And it's like, well, after an hour later, I feel like we got to them. Did we, Simon? We're like, what? We're not. It's not. We're trying to teach people how to become their own sovereign person. That's my whole goal. I told the guy, I said, 3 to 5 years from now, if we're still doing this show and I can look back and there's 30, 40, 50 people that we've touched and they've changed their life and they've become a banker on their own, I won. I win. Yeah, we won this battle.
I got the Super Bowl rings on my fingers now. That's on a soulful level, absolutely, and that's what really resonated with me with Nelson.
Yeah,
was that this movement of it's he didn't really go out there and say that how you just said it now, right? But he's wanting people, he wanted people to get this message, and it's far bigger than just not just taking over the banking function in your life. It's bigger than that.
It is
way bigger than that. It's huge.
I want to answer this question because it's a crypto question, and Brother Danny is in the house. Where do you see Cardano in the new financial system? Okay. I was really, really into Cardano 7 years ago. I'm still a huge fan of Cardano. I, full disclosure, own Cardano. I don't see it being a financial product. I think that's kind of the wrong question. You can ask any question you want. Shouldn't be a wrong question. I see it being more a people's coin, a platform in which systems, governance, and people and how we socially interact with each other on a institutional and governmental level. Mm-hmm. That's what Cardano is going to bring. Cardano is going to bring that in spades to where Ethereum is a joke in that sense. Cardano is the real deal for real people, for a real decentralized system. I don't know if you guys know, I'm sure Danny knows, but this week, Cardano is real close to being completely decentralized. There's absolutely nothing a human being can do to change what Cardano does from this day forward. And I believe it's any moment now. It's sometime this week or the end of last. That's something that countries and nations can build identifications on without it being corrupted. And that's really where I see this thing. In my opinion, it's a humanitarian coin. That's the way I see it. I see it being an incredible project. It's going to take time. However, I don't know if you guys have noticed, the Cardano and the XRP people, when Bitcoin shoots up for a while, and then we get this altcoin market, for whatever I don't know what the reason is, but XRP and Cardano seem to travel together. And I've never been able to figure it out. And like in the last few days, the only two coins that have really skyrocketed, they're both up like 30-40% in the last, whatever it is, 3 coins. Oh, XLM too. Is that what you're waving? No.
ICP.
Oh yeah.
CME.
Yeah.
For the CME. Mm-hmm.
Yeah. I mean, well, there's a lot of big things, but the why is Cardano up 40%? Like it's really, there's so much going on behind the scenes, and people are buying those top 10 old projects that have been around that they have the fundamentals, they have the people, and they know what they're doing. Enough about Cardano here tonight. Yeah. Digital IDs, Danny. Exactly. Yeah. Let's see. Okay, enough Cardano. What else do we have in here?
Let's see here.
Good night, Wayne.
Wayne's been gone. And also discipline and understanding. Yeah, Peaky's talking about discipline a little bit earlier.
This is a good one. I'm going to say, my wife's right here, so let me tell you. I'm going to say what our experience was. By the time we decided to contact somebody, there was emails back and forth. We set up an appointment. We had discussions, and you share your liabilities in life, and you come up with a game plan with this person. That's why I only recommend Nelson Nash people, because they're going to go through and they're going to say, okay, this debt's good, that debt's bad. And you're going to wait a minute. Whoa, that's not what I thought. And you're going to go, well, let me explain why I think this is good debt and this is bad debt. And they're going to help you decide, well, here's your bills and here's what you can do. And what do you think about this? And which one do you want to pay off first? Oh, okay, you got a chunk of money this year. Okay, let's put that to work for you. Let's show you how we can do that in the future. Not necessarily day one. You're not going to open an account and do it day one. You should go into it kind of slow. But I guess I'm not answering your question. It took about, Elizabeth, a month?
2 months.
2 months total?
I didn't even get the policy you can't even get the money, and then you have to, it's 3 months. It's a 3-month minimum process.
Really?
And that's because when he quizzed me, and if I said, if he that I did not understand the concepts, he said, okay, next, come back in 2 weeks, study more, come back.
And this is exactly why Simon and I are doing what we're doing. We want you to understand what you're getting into before you get to the guy who's going to help you with the insurance policy. That's what Simon and I are helping you with. All your dumb questions and that logical wheel that just slowly starts to gain momentum. You're like, wow, I get it. I'm starting to get it. Oh, he answered that question. Somebody asked a question. I would have asked that same one. Oh, Alan answered it different than Simon did last week. Oh, I'm putting this together. This whole puzzle is happening for me. And now I'm starting to get the concept and how this whole thing can work. Simon and I I'm not a salesman. I'm not here to sell you a policy. That's not what Alan does here tonight. Okay. What I'm here to do is help you become a better financier of your own wealth.
Yep.
And that's an educational process. It's a lifelong process for us to do that. This is one step. This night, this open AMA that we have every Tuesday night is for you guys to not sound like a complete dummy, or at least you're going to ask really good questions and you're going to get the right policy the first time. We hope. It's going to change your life. We hope. But we're not the guy to sell that to you. At least I'm not going to sell them anyway.
I'd like to answer this question too. To piggyback on what you shared, and both Elizabeth and you just shared.
Yeah.
It took me 30 days to get the policy, to go through the whole part of acquiring a policy. It took me 30 days. So that's contact, questions, health, review contract, verify funds, the whole coup de grace. That took 30 days. Okay, that part. How long did it take me to get to the 30 days? A little over a year, in an everyday conversation, whether it was 30 minutes or an hour, 4 hours, with my good buddy JB. We would talk every day, and I would talk with Alan too, and we would just do this kind of give and take with each other. Hey, I was thinking about this today. I read this in the book today. Hey, I was watching this video. This person said this, but it doesn't really 100% line up with this. What are your thoughts on it? Right? That's what's going on here, is that education, the questions, and then, hey, here's some people, because if I didn't have that, full transparency, if I did not have that continued conversation, that support, I wouldn't have a policy. That's me, though. Okay, that's me.
No, that's right. But okay. But correct me if I'm wrong. If 6-8 months earlier, if you were in a financial position to do so, you would.
Okay, fair. Yeah, I probably would have had one.
Right?
Okay. Yeah, I forgot about that. Right. I guess I was just putting emphasis on the education part, because I mean, if I would have got it then, would I have the respect I have for it now? If I had the money then, I probably would have gotten it. But did I have the knowledge that I have right now back then? No. Right. So, but yes, I would have pulled the trigger because I saw the value. right? I wanted to rush in and get it. And it was like, no, you need to learn this. And I did. I saw the value. I still see the value. I will always see the value. You know, I read it. Yeah. I listen to it. And now I want to be a part of this with Alan and teach it. You know, that's what we want to do.
And we're just bouncing info off of each other because like I say, we're not the person that's going to sell you the policy. We're the person that's going to head you in the direction of somebody that's going to treat you right. And, you know, we're going through the process of weeding out who those people are now. Homesteading with Nicole. I don't believe I've ever seen you in here. I don't know if you missed it, but I was just chasing pigs a minute ago. So yeah, we do a little homesteading around here.
Yeah, you do.
Good to have you in here, girl. We got 2 hours. 2 hours is up.
2 hours up. I got nothing more that we could expand on. I think we've done a lot of good discussion here. Yeah, a lot of level 1, a little bit of level 2, some level 4, a couple of level 3 questions and topics. Yeah. And as you guys know, grow in your knowledge of this whole thing, you're going to learn what level 1, 2, 3, and 4 really kind of means to you. It's a little different with everybody. It's kind of more like, I'd even say there's something before level 1, which is where you guys are at now, which is, what is this thing? And then there's a level 1, which is, okay, I'm going to use this for like a savings account. That's how you'll start. You know, I'll make myself fund this thing and I'll have money set aside. And then level 2 is kind of more like borrowing against it. Anyway. Your first endeavor.
Yeah, your first endeavor. That's right.
Absolutely. Yep. The first of many. The first of many.
Danny says XRP kicks off in January of next year from what I read. Okay. I think we're going to have a little boom before that, actually. We're kind of booming now, actually, if you want to know.
I was going to say, I think we're already kind of doing that, Chief. Frog's in the pond, bro, right now. How long that frog is going to stay there, who knows, man?
Yeah, we're up, what is it, since 4th of July, like 40, almost 50%.
I was just looking at ICP because I was talking about it. I was like, where was that dip into where we're at now? And it's like 70%. 70% from the wick down to current price action at 966, 65% move. Not a bad play. Would have been nice if you saw the direction and you had a nice policy to go, hey, can I borrow like a couple grand and go over there and do the thing? That's all right. I freed up cash. I did something better. Realized the gain instantly.
Right. Or
now I can go buy some more. Now I'm going to go buy some more crypto.
Bitcoin's up 300% in the last year. So, you know, you could have paid back the money that you borrowed and had 200% more coins. I'm just saying. Anyway.
And well said. Well said.
Yeah. And we need to get out of here. But
okay.
There was somebody in here, Luke. Luke, more questions, brother, anytime. Please, next week, think about when the show goes live next week, think about some great questions. We love the good ones.
And get the book.
And get the book already.
You go wherever you want. There's a link. There's a link in the chat. Scroll up, you'll find it. I posted. If not, go to Amazon. Go to maybe Half Price Books. I doubt it's there, but it could be. You know, go check it out.
Also, those of you who are in my Patreon group, if you're not, you could join.
Get over there.
And thestaplecrew.info will take you directly there. And we do, my lovely and talented wife, Elizabeth, who you saw earlier, and we do a PowerPoint masterclass, we're calling it, which is going through the book slowly, which could take us months of information that we're putting through there, which is really going to be fun. We're having a good time doing it. I think we're on episode 4 already, so you guys could catch up on that. Mary, hello. How you doing, girl? I remember you. Yeah, she introduced me to her husband. I believe that's the correct Mary. That we had a great time in Vegas. XRP Vegas. If you guys don't go, if you are into XRP and you can afford to go, please be there. We'd love to see you. Yes, Elizabeth, the poker mastermind. Yeah, Mary, that's her. That's all right. With that, I'm going to ramble on if I don't get out of here now. Thanks for your help, Simon. I really love that. Everything.
Always a pleasure, man. Thanks for having me on. I'll be talking IBC all day, every day.
I know that to be true. It's a game changer. All right, guys. With that, we'll see you next Tuesday with more with Simon and I about IBC. We'll see you then.